This is the Advanced Forex course for Smart Traders 2.0. It's Lesson 5, Achieving Your Goals Through Position Sizing, and I'm Sam Eder. Your position sizing model answers the question, how much do I trade? And it's a particularly important question for currency traders. Do you trade one lot or 5 lots or 10 lots? The answer to that question is going to produce completely different results for you. And you combine your position sizing model with your entries and exits to determine whether you achieve your goals or not. Your position sizing model is also a very important part of the risk management equation. If you trade too large, you can end up losing more than what you planned. Conversely, if you trade too small, you're not going to make as much as what you hoped. But how important is the position sizing model? Let's hear from a couple of market wizards to see what they say about this. Steve Clark, the founder of Omni Partners, goes as far to say, as although traders focus almost entirely on where to enter the trade, in reality, the entry size is more important than the entry price. The price is irrelevant. It's all about controlling the size of your position. William Eckhart, one of a duo of traders along with Richard Dennis, responsible for the famous turtle trading experiment, puts it simply, money management is more important than the price model. I use these quotes to make the point, as Steve Clark says, traders tend to focus too much on their entries, whereas it's just as important, if not more important, to be focusing on your position sizing model. And the way I like to think of it is your entry and exit rules, or how good your entry and exit rules are, determines how easy it's going to be for you to achieve your goals through your position sizing model. So you have to look at them combined together. There are a number of factors that influence your position sizing model, but it can all be a little bit overwhelming, I think. So I'm going to take you through some of them now, and then I'm going to give you a simple position sizing model that you can use so you know how much to trade in order to achieve your objectives. Some of the things to consider are how much you want to make, how much you're willing to risk, how often you trade. These are all very, very important considerations. You can consider how many losses your system might have in a row, your level of conviction about a trade, how strongly you believe in it, of course, where you place your stop loss. And if you're in a drawdown or a profit for a month, what will you do? Will that change your position sizing model? And then finally, if you're trading well or trading poorly. When developing a position sizing model, I like to think about this idea as well, the idea of being a risk manager first and a trader second. So our primary job is to protect ourselves and protect our trading capital. And we should think about that when we're developing our position sizing model. So we shouldn't necessarily be building a model that's going to give us these huge gains, although we can think about how to do that. The first consideration should be, how do I protect myself? How do I ensure that I stay safe and that particularly my initial trading capital is protected? Before we get into the position sizing model based on your objectives, I just want to talk a little bit more about how the position sizing model influences your results. So what I'm going to do here is I'm going to take you through 3 example position sizing models, and we're going to look at how with even the exact same entries and exits, you have very different results based on your position sizing model. So in this scenario, we place a trade, we have a 50 pip stop, we have a 100 pip target, and we're using a $10,000 trading account. In our first example, we base our position sizing on a number of lots. So let's assume we buy one lot. If we win, the trade goes for us and we've made 150 pips, and that would mean we've made $1,500. If we lose, it goes against us and we would lose 50 pips or $500, assuming we traded one lot. In model number 2, we use our account leverage. So let's assume we use 20-to-1 leverage. So we take a position of $200,000 or 2 lots. If we win, the trade goes for us and we make $3,000. If we lose, the trade would go against us and we'd lose $1,000. So that would be a 10% loss on our account. In position sizing model 3, we risk 2% of our account. And this means we trade $40,000. If we win, the trade goes for us and we make $600. If we lose, the trade goes against us and we've lost $200, only 2% of our account. So you can see from these different examples that we have dramatically different results based on how much we trade, even with the same entry and exit rules. Now I'm going to take you through a position sizing model based on your objectives. So this is one of the core teachings in this course. We size our trades in order to achieve our objectives. And there's lots of other position sizing models that you can use, but we always like to start here. So let's go through the different steps now. And just bear in mind that there's a calculator on the website that you can use to input all this information so that you don't have to do all the manual calculations yourself. So what we're going to do here is we're going to determine your 1R risk when you trade. So this is the simple concept of R multiples. You can go back to lesson 2 on statistics and probabilities if you need a little bit more information on how to calculate this. And then we're going to translate that 1R into an amount of currency that you can then key into your trading account when you go to place a trade. To determine your position size, you need to have the following information available from the previous lesson. So that's your desired return, your maximum drawdown, your number of trades, your win rate, and your risk reward ratio. In addition, you need to have how much trading capital you're prepared to allocate to the system. So to determine the position size for the system, you can use our position size for objective calculator. And this will allow you to determine your risk per trade in both percent and dollars. So how this works is we input our information into the calculator, and you'll notice that the calculator has a default risk percentage of 1%. So we leave that there for now. So just input your information in, click calculate, and it's going to spit out our results. So the results it's going to give you is your 1R, and it's going to give you your return percentage, your maximum drawdown, which is an estimated number. And I'll talk a little bit more about this in a second. And it gives you your expectancy both in R and in dollars. So here's the key final step. When you click calculate the first time, the numbers in the calculator are not going to match your return and drawdown percentage that you set from the previous lesson. And what we need to do is we need to make them match. So what you do is you change the risk per trade percentage in this calculator until the numbers start to match. And when they match, you then have your 1R per trade. So this may take a few attempts. You may need to adjust it lower, or you may need to adjust it higher. So in this case, let's assume I had a return percentage goal of 5%. I've now adjusted the risk per trade percentage so that that matches. So I've now got my return percentage goal matching my position size. But there's one more thing I need to check. The other thing we need to check is if our maximum drawdown limit is exceeded. And to do this, we use a Monte Carlo simulation. So all a Monte Carlo simulation does is it runs our results 10,000 times. So what we've put in the calculator, it will do that 10,000 times, and it will calculate all on each of those 10,000 times it ran those results, what the drawdown was. And then it graphs them. And you can see here, in this case, that the largest drawdown out of 10,000 times these results were run was 4.22%. So chances are we don't ever achieve that if we produce these results, because this is the worst case out of 10,000. But we can know that with a degree of confidence, we're going to remain within that level when we're trading our trading strategy. So this just gives us a tool for checking that our maximum drawdown is not going to be exceeded. So you can see the maximum theoretical drawdown is calculated here in our set of results. If that matches with our objectives, we now have a position sizing model that meets both our return objective and our drawdown objective. So this forms the core of the position sizing model for our course. But there's heaps of variations you can add. So what I'm going to do now is I'm going to take you 3 variations of our position sizing model that I think are particularly important and relevant to Forex traders. The first of these position sizing model is designed for new traders or for traders that are starting a new trading strategy. So the concept here is we have our core capital and then we have markets money. So core capital is the money we put into the trading account. So let's assume we put $10,000 in, that would be $10,000 of core capital. Markets money is profits we've made. And the idea behind this position sizing model is while we are risking our own core capital, we have a reduced position size. So you might trade at 50 or even 20% of your normal position size. And then when you have some profits in the account and you're risking markets money, you then increase your position size back to the planned normal size. And this is a way of protecting your initial trading capital. And remember, we want to be risk managers first. So I think this is a great concept here for new traders, or when you start trading a new trading strategy and you're still trying to iron out the bugs or understand the different nuances of it. The second model here is called Bullets, and it's developed by Ken Long for day traders. So what you do here is you set a loss limit for the day, and then you split your risk into different bullets. So rather than risk per trade, it's risk per day. So let's assume you had a risk on the day of $1,000. You expected to place 5 trades. Rather than risking $1,000 on each trade, what you would do is maybe risk it at $200 per trade. So you're firing, say, 5 bullets at $200 per trade. So this is a great position sizing model for day traders who want to have a tight control of their risk on any given day. The final model I want to mention here is conviction-based position sizing. So in a conviction-based model, you're increasing your risk or you're scaling in on high conviction trades. So essentially, where you have great belief that a trade is going to go in your favor, you trade larger sizes. And as we'll talk about later in this course, this is a very valuable way to think about position sizing and indeed trading in general. So there's a lot to unpack from this lesson. So I want you to keep it relatively simple. The idea with position sizing at this point in time is you want to be directionally correct, i.e. you want to be trading a size that's roughly going to achieve your goals and that's going to allow you to properly manage your risk. Also, I think importantly from this lesson, for a lot of traders, I want you to take away this concept of core capital and trading smaller when you're risking your own money and then trading larger when you're risking the market's money. I think these are particularly important concepts to take away from this lesson. In the next lesson, we're going to talk about low risk, high reward trade ideas and how to identify them. I'll catch you then.